Let's get some perspective on how investors are trying to navigate through these choppy markets. Michelle Schneider is Managing Director at Market Gauge Group. Mish, it's always nice to see you. What a week it has been. Where has it left your mind, your mindset, as we wrap up the trading week?
Well, this is really a good time to step back and look at the markets with somewhat of a cool head, because what we saw was absolute hysteria. Wednesday, after Powell spoke and the FOMC notes were released, and then Thursday with the ensuing drop. So here we are. If we step back, this is not anything unlike what we would have expected for this year, which is we will establish a level of a trading range. And that means that we could see relative support at these current levels hold for a while. The question is what happens in terms of a rally. And I think that what we've seen with this volatility is that that's actually going to decrease, and the trading ranges will get smaller, which will be frustrating for people. But eventually, people will have to understand that there's huge performance or return on their money right now is pretty much a thing of the past and reflects exactly where we are economically. We're stagnating while inflation continues to grow.
For those investors who have looked at those same charts you're talking about and seen some significant carnage, particularly in areas like growth, what is it that is going to keep the lid on performance there? Is it just this simple narrative that when interest rates go up, whether or not we end up seeing a recession or not, that it's just a less favorable environment for the kinds of stocks that were star performers of these last couple of years?
Well, absolutely. When you look back, the last time the Federal Reserve actually hiked was in March of 2000. So that means we've really had over 20 years of accommodative policy by the Fed, which has allowed a lot of these growth stocks to grow. And then companies that haven't really had great balance sheets to borrow at nothing. Those days are over. So in terms of what's fair value, I think that will be the discovery that we'll see, particularly in the big stocks like Amazon and Apple and Microsoft, et cetera. Do I think longer term those companies will be solid? Yes. But could they actually just sort of, again, use the word stagnate? Find a period and a range where the low sits, but they don't really go very much higher over a course of a few years? Well, it happened before. If you look back at the 70s, when we just basically stagnated within a range till we had the hyperinflation followed by recession and then finally economic growth. So we're kind of right there. That's exactly where we're at.
The challenge is the money has been moving so quickly. I think it has left investors feeling whipsawed. A great example, I actually referenced it off the top, were financials. You know, coming into this year, we were being reminded by a lot of the pundits, well, interest rates are going up. So you know what? Buy those stocks because those companies will benefit from higher interest rates. But because we have seen just this flurry of news, aside from inflation that seems out of control and a central bank fight that's going to be very interesting to watch, the lockdowns in China over the COVID concerns, which crimped demand, and of course, that inflationary impact even greater because of Russia's invasion of Ukraine. I mean, is it just this big macro soup that we didn't see necessarily coming, even though there was a trend or a reality that rates would have to go up, that has just made this even more volatile?
Well, some of us didn't see it coming. Actually, John, you and I have talked about this for months now. But, you know, to that point, I think it's really important to remind your viewers that people who are Wall Street analysts who work for Wall Street firms or economists who are paid by companies to say what they want them to say, they will tell you to buy constantly and to just sit and wait. And for some people, that might be okay. But for most of us, it's not. And that's why we've seen this big rush to the exit. But yeah, we are in a soup. Everything that is basically the old adage, except for maybe sell and may go away, that seems to be working so far. Just throw that out the window. Yeah, higher rates mean good for banks? Not so much. The fact is right now that the banks are falling down. Could they recover? I would not go there first as a first point of where I would start establishing along. I would still want to be looking at things that are more non-cyclical in nature. And that's really where I might start to establish equity positions. But for right now, I'd say be very careful in what you trade. Don't expect huge returns. Become a trader, an active trader, and continue to look at commodities because I don't even think we've seen the beginning of a gold move yet.
I want to talk about that real quickly, Michelle, before we let you go, because sometimes we reference our previous prime minister who talked about living next to the U.S. like sleeping with an elephant. That outsized influence of technology in the U.S. has really taken, a knife to valuations for U.S. equities, and it is very much true for a lot of our growth stocks here in Canada. But there are still at least 5 subsectors of the TSX that are well into the green this year. The commodities names, energy, you referenced some of those materials and gold that we have seen investors gravitating towards. So I guess we should remind our audience that it depends on what you're investing in this changing cycle when we're trying to figure out direction here.
Absolutely. I mean, if you follow the 60-40 rule, you are having a very tough time. But just to talk about gold for a second, again, I like to look at history. And when we got into the late 70s, gold had still been underperforming the SPX, while other commodities had already taken off. And gold was sort of the last commodity to take off, and took off, as we know, with veracity, as you look at the end of 79 into 80 until the Volcker thing came about. And I think we're there again right now, because at some point people are going to look around and go, what's left? Is it miners? Not necessarily, because we have supply chain and labor, but pure physical gold at some point this year, I still believe, will have this huge spike up. And that's really where we're looking to put the bulk of our money once that happens.
All right.